Most people fail at business not because they lack effort, but because they don't understand the language of money. This video fixes that and above all, visually. Assets. What a company owns: cash, inventory, property. A store has $5,000 on bank, $2,000 inventory, and a delivery van. All these are assets. Current assets. Assets that can be converted to cash within a year. Cash, inventory, receivables. A shop has $2,000 cash and $15,000 inventory to sell soon. Fixed assets. Long term resources used in business operations, machinery, buildings, and factories. A factory buys a 30,000 production machine is a fixed asset. Equity. Owners share in the business after paying liabilities. If assets are $10,000 and liabilities are 4,000, equity will be $6,000. Liabilities. What a company owes: loans and bills. The business owes $3,000 bank loan and $500 supplier bill. All are liabilities. The company has to pay these. Current liabilities, debts that must be paid within 1 year. A company must pay $2,000 supplier bill within 30 days. Long term liabilities, debts payable over more than 1 year. A business takes $50,000 loan to be paid over 5 years is a long term liability. Shareholder equity, residual value for owners after liabilities are paid. Assess $100,000 minus liabilities $40,000 equals equity $60,000. Cash and cash equivalents, liquid funds or money available immediately, cash and bank balance. A company keeps $77,000 in its business bank account is cash. Inventory, goods held for sale to customers. For example, a clothing store keeps 300 shirts and 150 jackets to sell. Accounts receivable, money customers owe the business for products or services already delivered. For example, a retailer bought goods worth $800 on credit and will pay next month. Accounts payable, money owed to suppliers for purchased goods. For example, a store buys inventory worth $1,500 but will pay the supplier next month. Prepaid expenses, payments made in advance for future services. For example, a company pays $1,200 for 1 year of website hosting in advance. Intangible assets, non-physical assets with value, patent, for example, patents, trademarks, software licenses. For example, a company owns a registered trademark for its brand name. Goodwill, extra value paid when buying another business due to reputation or customer base. For example, a company buys another for $2 million even though its assets are worth $1.7 million. The extra $300,000 is goodwill. Accrued expenses, expenses incurred but not yet paid. For example, employees earned $4,000 salary this month, but payment will be made next week. Common stock, ownership shares issued to investors. For example, a company sells 1,000 shares to investors to raise capital. Dividends, portion of profits distributed to shareholders. For example, a company pays $2 dividend per share to investors. Working capital, current assets minus current liabilities, money for daily operations. For example, current assets $15,000 minus liabilities of $6,000 equals 9,000 working capital. Liquidity. An ability to pay short-term obligations quickly. For example, a company with $20,000 cash to pay $5,000 bills has good liquidity. Deferred revenue. Money received before delivering goods or services. For example, a customer pays $600 for a yearly software subscription in advance. Retained earnings, profits kept in the business instead of paying shareholders. For example, a company earns $20,000 profit and keeps it for future expansion. Short-term debt, loans that must be repaid within 1 year. For example, a company borrows $5,000 from a bank for 6 months. Long-term debt, loans payable over several years. For example, a company takes a $200,000 loan to buy a building, payable over 10 years. Solvency, ability to meet long-term financial obligations. For example, a company with low debt and strong profits is solvent. Book value, company's net value based on accounting records. For example, assets $500,000 minus liabilities $200,000 equals $300,000 book value. Debt to equity ratio, comparison of debt with owner funding. For example, debt $30,000 and equity $60,000 will be ratio 0.5. Additional paid in capital, extra money investors pay above the shares face value. For example, share value is $10, investor pays $15, extra $5 is additional capital. Thank you very much.